Hello everyone. Let's start our today's discussion. I hope you all remember that in previous class we started our discussion on first chapter of our advanced taxation course, and this was basic income tax calculation. In our today's class we will move forward with our discussion of this chapter, and we will be having discussion in relation to taxation of dividend income and some rules relating to taxation of trust income. But before going in detail of our today's class, let's take a quick review of what we have discussed in the previous class. In the previous class, we looked at the basic format of the income tax return, that individuals who are UK residents have to divide their incomes earned during a tax year in three heads. The first head was a non-saving income head, which includes all the normal incomes. The second head was saving income, which includes interest income. And the third head was the dividend income. The reason of dividing the income in these three heads was that all of these three heads have different rates of tax. In the previous class, we looked at the non-saving income, which is the normal income head, which includes all incomes except interest income and the dividend income, because they are classified under their own respective heads of saving and dividend. You add up all of the incomes, you arrive at the total income. You adjust your personal allowance, which is £12,570 for the current tax year. You arrive at the value of taxable income, and using the tax bands, you calculate the tax. This all discussion was done in the previous class. I hope you all remember, because we applied it in 6 practice questions, which we did in the previous class. We also looked at the tax year, that in UK, the tax year starts on 6th April and ends on 5th of April. We are talking about Finance Act 2024, which is the tax year starting from 6th April 24 to 5th of April 2025, which is 24-25. And it is relevant for the exams of June, September, and December 2025 and March 2026. We looked at all of this. We applied it in the practice question. Then we had discussion on the concept of real estate investment trust, which are the mutual funds, raise investment from the people, and then invest in the real estate or the property market. Okay, for the tax perspective, the dividend received from the real estate investment trust is not taxed as a dividend income. Rather, it's taxed as a non-saving income, since it is being earned from the property market. Withholding tax is 20%, and it is taxed on the receipt basis. We looked at all of these issues in the previous class, and we had a lot of practice questions also. Now, in our today's class, we are moving forward, and we will be looking at one more head of income. We talked about non-saving income. Now we are talking about dividend income. As we move forward, we will be looking at more incomes and further income heads, and we will be including them in our practice questions, so that you can have an idea that how exactly the individuals have to do their tax calculations in UK. Now, when we talk about dividend income, first of all, what is dividend income? Profit distribution done by the companies. When the companies do the profit distribution and the profits received by the individuals, those are considered as dividend income. Okay, when a company earns a profit and makes a distribution, the distribution received by an individual will be considered as dividend income, on which the individual will have to pay income tax. Okay, now the dividend income is taxed as a separate head of income. Non-saving was a separate head. Saving income, interest income is a separate head. We will be discussing about saving income in the next few classes. Saving income has a bit technical and complex rules, so leaving it for the time being, we did the non-saving. Now we are talking about dividend income, which is also very easy. Now the tax rates of dividend income are different, and they are less than the normal tax rates. Now you must be thinking why. If you want to inquire about the reason, see, normally in tax there are a lot of rules. So in majority of the situations, teachers say that it's a simple rule. But wherever possible, I try to give the reasoning. See, the tax rates of the dividend are less than non-saving income. Like where the non-saving income had a tax rate of 20%, dividend income is taxed at 8.75%, a fairly lesser rate. Why is it so? See, the profits which a company earns, the company pays corporation taxes on it. We'll study corporation taxes in later part of the course. The company pays corporation taxes on its profits. Once they have paid the corporation taxes, they get the profit after tax. Now, from that profit after tax, they pay the dividend. So, the profits which are being used to pay the dividend, they have already been taxed in the corporation taxes. So, basically, when we see this dividend income, it is getting same profit tax twice because the company has already paid the tax on those profits, and then using those profits the company is paying dividend, and on the dividend the individual will have to pay the income tax. So this is the reason why, since it has already been taxed inside the company, for the individual who is getting the dividend income, the rate of tax is kept lower. So dividend income received by an individual during the tax year is classified as a separate head of income, as dividend income has its own separate tax rates. The tax rates and the bands will be available in the examination, so there is nothing to worry about. You just need to understand that how you have to apply it. Otherwise, the rates will be available in the examination. Now, when we talk about the tax rates, in the basic rate band, 1 till 37,700, the tax rate of non-saving income is 20%. But for the dividend income, this tax rate is 8.75%, a different tax rate and a lesser one. Higher rate band, 37,701 to 125,140. Non-saving income is taxed at 40%, but dividend income is taxed at 33.75%. Then in additional rate band, above 125, 141, non-saving income is taxed at 45%, whereas dividend income is taxed at 39.35%. These rates will be available in the exam, so don't worry about it, that how you learn it. They'll be available, so nothing to worry. See, first you tax your non-saving income. When you will tax your non-saving income, it will consume your bands. Dividend income will then be taxed on the remaining bands. These are the same bands. They will be first used in non-saving. And if any band is remaining, that will be used in dividend income. How that works? When we will apply the practice question, it will get crystal clear, so nothing to worry. First, 500 pounds of dividend income are always taxed at 0%. Whatever dividend income you have, first 500 pounds in the tax year are always taxed at 0% when we talk about dividend income. Now, this is something different. It wasn't in the non-saving income. And on dividend income, there is no withholding tax. Like in real estate investment trust, there was withholding tax, advanced tax of 20%. On normal dividend incomes, there is no withholding tax. Okay. So what is dividend income? Profit distributions done by the company. Now, when an individual is getting those profit distribution, it is called as the dividend income. It's taxed under its own separate head. Dividend income has its own tax rates. First 500 pounds of the dividend income is taxed at 0%. On dividend income, there is no withholding tax. You get the entire amount just like the trading income or the property income. Let's apply this concept on the practice questions. We'll be doing 3 practice questions in this regard. And believe me, it will be very easy. So don't worry, don't take any stress. Just listen to me carefully. Mr. Z has following incomes for the year. Trading income is 39,000. Employment income is 4,000. And dividend income is 10,000. We have to do the tax payable. Let's look at it. Now, we are looking at income tax return. We are looking at income tax return. In income tax return, we have a head of non-saving. And now we have one more head, which is of dividend. The dividends are taxed under their own separate head. So, listen to me carefully. Trading income is 39,000. That goes under the head of non-saving. You have employment income of 4,000. That also goes under the head of non-saving. And then you have dividend income of 10,000. Dividend goes under the head of dividend only. It is taxed as a separate head. No withholding tax on normal dividend income. I believe this is not difficult, just routine. You add up all of them to arrive at the value of total income. So your total income is 39,000 plus 4,000, it will be 43,000, and the dividend total is 10,000. You adjust your personal allowance against the non-saving income first, because non-saving income has the higher tax rates. Personal allowance, obviously it's beneficial to hit that income which has greater tax rates. So now you arrive at the value of taxable income. I believe that it's just performing the routine steps and there is nothing difficult in it. So your taxable income is 43,000 minus 12570. So that gives us 30430, and this is 10,000. Now let's charge tax on it. Let's charge tax on it. Your non-saving income is 30430. I hope you guys remember the basic rate band. Till 37,700, the rate of tax is 20% when we talk about non-saving. So obviously this 30430 lies in the basic rate band, which is still 37,700. So 20% on it, it gives you 6086. Okay. Now comes the dividend income. So your dividend income is 10,000. First 500 pounds of dividend income are always taxed at 0%. So here you go. Now let's look at the basic rate band. I want you all to listen to me carefully. See, your basic rate band is still 37,700. Use your mind. Now from this 37,700, 30430 was used by non-saving income, 30430, and 500 pounds was used by the dividend income, which was taxed at 0% rate. That is also using the band because that was also the portion of the income. So this means you have only 6770 available in the basic rate band. See, your basic rate band is 37,700, 30430 used by the non-saving income, 500 pounds used by the portion of dividend income. Now the remaining basic rate band is 6770, on which you will apply 8.75%, which is the basic rate of tax for the dividend income. So your tax will be 592. So now, if you look at your dividend income of 10,000, 500 was taxed at 0%. Okay. 6770 was taxed at basic rate band. So how much is remaining? 2730. It will be taxed at the higher rate band, which is 33.75%. So 33.75%, that gives us 921. Here you go. Your final tax liability. There was no advance tax in this question. 6086 plus 592 plus 921. So it's 7599. Let me repeat it again. I believe that it's not difficult. Just you need to listen to me carefully. If you look at this question, you had trading income, which is a non-saving income. You had employment income, which is also a non-saving income. Dividend income goes under the head of dividend. You add up the incomes, you arrive at the value of total income. You adjust the personal allowance to arrive at the taxable income. Now, 30430, it's within 37,700, so it will be taxed at 20%. Dividend, first 500 is always, first 500 pounds is always taxed at 0% when we talk about the dividend income. Here you read it. Then the rate of tax of dividend income in basic rate is 8.75. In higher rate, it's 33.75. These rates will be available in the examination. Just look at the remaining space in the basic rate band. 37,700 minus 30430 minus 500, so it was 6,770, charged at the basic rate of band 8.75%, and the remaining of the dividend income was taxed at 33.75. Since there was no adjustment of withholding tax, so this is your liability and the payable same, because there is no adjustment of the tax credit in this question. I believe that it's not difficult. Like if you look at it, just the working of the dividend, I believe it was pretty much straightforward. Is it clear? Done. Now let's move forward. Let's do one more question. As you do more and more practice, the things will get clear. Mr. B has following incomes for the year. Trading income 27,000. Dividend income 20,000. Real estate investment trust dividend 5,000. See, the dividend of real estate investment trust is not a normal dividend. It's a dividend from a mutual fund, which is from real estate market, so you tax it as a non-saving income. Let's look at it. I want you all to listen to me carefully. We are making income tax return. Okay. There are two heads of the income, non-saving, which is the normal income, and the dividend income, because now we are having dividend incomes in our questions. Okay. Trading income. How much is the trading income? Trading income goes under the head of non-saving, 27,000. Okay. Then the normal dividend income, on which there is no withholding. Normal dividend income goes under the head of dividend income, and then comes the real estate investment trust dividend. It goes in non-saving income. We have already studied this. Now on real estate investment trust, there is withholding tax of 20%. You all know. So you gross it up, divided by 80%, multiplied by 100%. We studied this in the previous class. So that gives us 6250. Real estate investment trust, there is 20% withhold. Okay. And when the question is silent, we assume that whatever we are being provided is the net amount. Here you go, you get your total income. So your total income will be, if you look at it, 33,250 and 20,000. Okay, you adjust your personal allowance in it. You'll adjust your personal allowance in it. Your personal allowance is 12570. And here you go, you'll get your taxable income. Okay, so now what's your taxable income? Let's look at your taxable income. 33,250 minus 12570, it's 20,680, and here it's 20,000. Done. Let's charge tax on it. Non-saving income 20,680. The basic rate band is still 37,700. Obviously this 20,680 lies in the basic rate band, because the basic rate band is still 37,700. You charge 20% on it, that gives you 4,136. Then you have the dividend income 20,000. Always first 500 will be taxed at 0%. That gives you 0. Okay. Let's look at the basic rate band. Your basic rate band is 37,700. What's the remaining space in basic rate band? Your basic rate band is 37,700 minus 20,680 used by non-saving and 500 used by the dividend income. So now the space in the basic rate band is 16,520. The basic rate of tax for dividend income is 8.75%. The basic rate of tax is 8.75%. So that gives us 1446. I believe that this is not something difficult which an advanced taxation student will feel any difficulty. Your non-saving income till 37,700, it's 20%. Okay, till 37,700, the non-saving income is taxed at 20%. It was 20,680 taxed at 20%. Dividend income first 500 at 0%. Then the remaining space in band taxed at 8.75%. Now, what's the remaining dividend income which you have been left with? 20,000 minus 500 minus 16,520. So you have 2,980 remaining. Higher rate of band 33.75. Here you go. That's 1006. You add up all of them to arrive at the value of tax liability. Okay, 4136 plus 1446 plus 1006. 6588. Here in this question, there was some advanced tax paid on real estate investment trust. You will adjust that to arrive at the value of tax payable. What was the credit? If you remember, real estate investment trust, you grossed of 5,000 to 6250. You adjust your credit 1250. And here you go. 5338. So if you look at it, I believe that it's not something which is difficult. You already have studied the non-saving income head in the previous class. All the incomes go in non-saving except the interest income and the dividends. Real estate investment trust, you already know there is 20% withhold. It's taxed as a non-saving income. The normal dividends are classified in the head of dividend income. There is no withhold. Then the rates of tax. First, you tax your non-saving income. On dividend income, first 500 at 0%. You look at the remaining space in the band. You tax 8.75%. And then the remaining dividend income goes at the higher rate. So, the profit distributions which an individual is receiving, so that is regarded as the dividend. It is taxed under the separate head of dividend income. You look at the rates of taxes for the dividend income. First 500 pounds of the dividend income are taxed at 0% rate. There is no withholding tax on dividend income. We looked at all of these issues. I hope that you guys are getting it. Okay. And then we applied it in two practice questions also. One more practice question before we move forward. What I want from you guys is that you can pause the recording and try it on your own also so that you can have a better illustration and understanding. I'm doing it, but you can pause and try it on your own also. Mr. A has following incomes for the year. Employment income 12,000, dividend income 7,000, and real estate investment trust 4,000. We have to do the tax payable. Again, very easy. Income tax return. So you have non-saving income head. You have the head of non-saving. Then you have the head of dividends. Okay. The employment income will be, employment income goes in the head of non-saving, 12,000. Dividend income, 7,000, goes in its own head. Okay. And then comes the REIT. Real estate investment trust, 4,000, divided by 80%, multiplied by 100%, because on REIT, there is a withholding tax of 20%. I hope you remember. So 4,000 divided by 80 multiplied by 100, that gives us 5,000. And it goes under the head of non-saving because real estate investment trust earns from the property market. You add up them to arrive at the value of total income. So what's your total income? 12,000 plus 5,000, here you go, it's 17,000. And the dividend stands at 7,000. Then you'll be adjusting your personal allowance. So your personal allowance is 12570. You adjust that 12570. Okay, I believe these are just the simple steps which I'm doing. You arrive at the value of taxable income. Here you go. Taxable income. 17,000 minus 12570. So it's 4430. And here it's 7,000. Then you'll be charging tax on it. Non-saving income 4430. Obviously, it's within 37,700. So the basic rate band, it applies 20% of the tax on non-saving, 886. Then comes the dividend income, 7,000. First 500 pounds of the dividend will be taxed at 0%. That's zero. Now, if you look at the data, 7,000 and 4430, it's just around 11,000 and something. Your basic rate band is of 37,700. So obviously this entire thing lies in the basic rate band. So this 6,500 will be taxed at basic rate, which is 8.75%. 6,500 into 8.75%. So that gives us 569. You add up them to arrive at the value of tax liability. Okay, here you go. Your tax liability 886 plus 569. So it's 1455. There was some advanced tax also in this question. Let's adjust that. And we'll get our final tax payable. So what was the advanced tax? You grossed up the rate from 4,000 to 5,000. Withholding impact, so 1,000 was paid in advance. So here you go, it's your tax payable of 455. So if you look at this question, I believe that this was an easy one. Employment income. Dividend goes under the head of dividend. You grossed up the real estate investment trust. You arrive at the value of total income. The adjustment of personal allowance, you get your taxable income, and then just applying the tax rates. 37,700 is your basic rate band. So obviously 4430 lies in the basic rate band, and it was taxed at 20%. Then dividend income, first 500 at 0%. Obviously there was a lot remaining in the basic rate band. So there was no need to make this working. It was apparently all within the basic rate band because band is of 37,700. You tax the basic rate of dividend income 8.75%. You adjust your advance tax to arrive at the value of tax payable. So dividend income is the profit distribution we are getting from the companies. It is taxed as a separate head, having its own rates of tax. Don't worry about the rates. They will be available in the examination. First 500 pounds of the dividend income are always taxed at 0%. And on dividend income, there is no withholding tax. Okay, we applied this in 3 practice questions. I believe that you guys must have understood it. Now, let's introduce one more income. We are picking up the new concepts, we discuss them, we apply them in the practice questions so that the concept gets cleared. Now, the next income which we are looking is the trust income. Okay, what the trust income is, how it is taxed, what is a trust, let's look at that. Just like the real estate investment trust, just like dividend income, just like the normal concept of non-saving, Now we'll look at the trust concept. We'll be looking at its taxation, and we'll be doing few practice questions on that regard also, so that the things get clear. So if you look at my teaching approach, we are building the structure, small bricks, small steps. We introduce a concept, we do practice questions so that it gets clear. And so on, we will be moving. Once the chapter gets completed, then there will be the homework assignment so that you can have an evaluation that where you stand. Okay, so now let's start our discussion on the trust income. What is trust and how it is assessed? Now, when we talk about the concept of trust, the trust is a separate body, is a separate entity which is created for the benefit of beneficiaries. Now, how does a trust operate? In a trust, a separate body, a donor gives the assets, one party, a donor gives the assets. Those assets are managed by the trustees. And the benefit of this trust, the income of the trust is given to the beneficiaries. What is a trust? Let me repeat it. Trust is a separate entity or it's a separate body in which the donor, one party donor gives the assets. Those assets are managed by the trustees and the benefit or the income of the trust is given to the beneficiaries. Now you must be thinking that why this trust is created. So there are multiple reasons for it. For example, consider a situation when parents are of very old age and their children are very young. Now the parents are ill and they are getting confused or they are getting stressed that after their death, how their children will manage the business. So they will create a trust. These parents will give their business, their assets into a trust. They will become the donor. They will appoint a board of trustees like board of directors to manage this trust and to give the income to their children as the beneficiary. So practically there are many trusts in which there are donors, trustees and the beneficiaries. You can find them in a lot of social organizations, like for a lot of social works also the trusts are created where there are donors, there are board of trustees and then there are beneficiaries who are getting the benefit. Now here we have to discuss that when a beneficiary will be getting the income, how it will be taxed from the UK tax perspective. Okay, let's look at it. Trust is a separate body, it's a separate entity in which the donor gives the assets, donates the assets, which are managed by the trustees. The trustees are like the board of directors. They take the decisions, they look after day-to-day operations for the benefit of the beneficiaries. Now, why is this trust created? There are multiple reasons. Income is to be given to those who cannot manage it. Like, for example, you have small children, you have young children, and they cannot manage the activity themselves. So you create a trust for that purpose. Similarly, if you want to give income to any social entity or if you want to give income to some family member and you know that he cannot manage it himself, he cannot manage that business activity. So in that case, you create a trust. Okay. And what will be happening is that the trust will be managed by the board of trustees and the income will be going to the beneficiary. Second reason is that income is to be given in a systematic manner. Like what we can do is that we develop a constitution of the trust. We write that, okay, every year or every month, a certain amount will be given to the beneficiaries. Because if we are afraid that beneficiaries may misuse the amount or they may do over extraction, so we may develop a systematic manner also. So what is a trust? It's a separate entity or it's a separate body in which the donor is giving the funds, is giving the assets. It is managed by trustees like the board of directors and the income of the trust is given to the beneficiaries. Why is the trust created? The reason is that we want to give income to someone who cannot manage that source of income on himself. So that's why we are creating a trust. We are appointing the board of trustee to manage it. Or we want to define a systematic manner or a cycle that how much amount need to be given every month or every year so we can create a trust. Now, other reasons for creating trust can be that the trust can be created for income tax planning purpose. Now, you must be thinking how? See, what you can do is that, for example, if you are doing any business activity, then rather than taking out entire income on your own name, if you will take out entire income on your own name, your rates of tax will increase because obviously you will be going for higher bands. So what you can do is that you can shift your business in the trust. You yourself become the trustee, and now you extract the income on name of multiple family members. So in this way, you can use their personal allowances, tax bands, and everything. Now, student will ask a question. Let's say you can do same thing by giving shares to your family members, like give them the shares. See, when you give the shares, they become the owners and they will start interference. But in the trust, they will just be the beneficiaries and they'll have no interference. So what we do is that we shift our business activity into the structure of trust and we create multiple family members as the beneficiaries with the aim of using their personal allowances and the basic rate bands. Now, this is what we call as tax planning. It's not a tax evasion. It's not stealing tax. It's tax planning, which is permitted. Another reason is to do inheritance tax planning. You will be studying inheritance tax in detail in the future part of the course. Basically, inheritance tax applies whenever the assets are gifted. So, for example, if the assets are on my name and when I will die, it will be gifted to my family member, and on that, 40% inheritance tax gets applicable. And on every generation transfer, on every death, such big amount of inheritance tax gets payable. So what I can do is that I can shift the assets to the ownership of the trust. I can shift the assets to the ownership of the trust. Then in that case, when I will die, there will be no inheritance tax being payable or on the death of my children or their children because the assets are in the ownership of trust. Yes, when you give the assets to the trust, one time at that time inheritance is payable, but for later generations, inheritance tax gets saved. So, since you haven't studied inheritance tax yet, it's just the start of course. So, for now, just understand that when you give the assets to the ownership of trust, since now it is not in the ownership of individuals, so on every death, the inheritance tax which would have been payable, that would get saved. So, what is a trust? It's a separate body, a separate entity which is created in which the donor is giving the assets. Those assets are managed by the trustees, and the benefit, the income is being given to the beneficiaries. Why are we creating the trust? So that the income can be given to those parties who cannot manage it themselves. The income can be distributed in a systematic manner. Income tax planning can be done like extracting the income on the name of multiple beneficiaries, use their personal allowances and the tax band. You can do inheritance tax planning. Now, what do you mean by inheritance tax planning? Rather than keeping the assets on the name of individuals, which will be subject to inheritance tax on every death, keep it on the name of trust, which will not die. Just the trustees and beneficiaries will keep on changing. You can create the trust while you are alive, or you can create at the time of death also through your will. Like sometimes when a person dies, he writes in the will that, okay, after my death, give the assets to the trust and they will be the trustees and these parties will be the beneficiaries. So you can create it through your will also. Now, there are two types of trust. One is discretionary trust, and other is the interest in possession trust. Now, what is it? Let's look at it. In our today's class, we'll look at discretionary trust and we'll do the practice questions of that. We'll look at interest in possession trust in the next class. You have to go step by step, slow, no rush. See, discretionary trust is a very special type of trust which is created for tax planning, which is created for saving tax. Discretionary trust operates according to the discretion of the trustees. Those people who are managing it, they have the full-fledged power in the discretionary trust. They can do all the decisions, they can change the beneficiaries, they can change the activity, they can close the trust. Discretionary trust, word discretion refers to power. Discretionary trust operates according to the discretion of the trustees. Trustees can take all decisions. Beneficiaries have no fixed rights. They can change the beneficiaries also. See, discretionary trust is created for tax planning. You change the beneficiaries every year. You identify those family members who have the personal allowance available, who have the basic rate band available. You change the beneficiaries every year. Your entire objective is to do the tax planning. Okay, try and understand. You don't create discretionary trust for other reasons. Like, for example, if I'm dying and I want to make sure that after my death, the income is given to my children,
I'll not create discretionary trust because trustees will change the name of the beneficiaries. They will put their own children name instead of my children name. For those reasons, there is another trust called as interest in possession trust. Currently, we are talking about discretionary trust, which is created for tax planning. The sole objective is to do tax planning, adjust the beneficiaries. Normally, what happens in discretionary trust is donor creates the trust and makes himself as the trustee. He has just created the trust for doing tax planning. Nothing else. Nothing else. We make this trust while we are alive. We make ourselves or our close family member as the trustee, and then we manage it to do the income tax plan. If you make any third party as a trustee, he will take away everything. Now, since the objective is tax planning, so tax department has kept some strict conditions on it. Income received from discretionary trust is taxed on following manner on the beneficiary. It's taxed on receipt basis, which means in the tax year in which you are receiving. It is taxed as a non-saving income, and its withholding tax, advanced tax is 45%, which is the highest withholding. But for withholding tax, there is nothing to worry about because that is adjustable. You all know. You can adjust the withholding tax against your tax liability. Just listen to me. What is a trust? Trust is a separate entity, it's a separate body in which the donor is giving the assets. Those assets are managed by the trustees and its income is given to the beneficiaries. Why are we creating trust? Because we want to give income to someone who cannot manage that activity himself. We want to create some system or structure of income distribution. We want to do some income tax planning by adjusting the beneficiaries. We want to do some inheritance tax planning. Okay. Now, within this, there is a discretionary trust, which is a purely tax planning trust, in which the donor himself makes himself a trustee and uses the trust to change the beneficiaries, select the beneficiaries which have the personal allowances and the tax bands available so that he can take the benefit of saving the income tax. There is one more type of trust, which is interest in possession trust, which is a fixed trust, operates according to the rule, according to the constitution. Trustees are just an employee. But that's a separate debate. We'll do that. Currently, we are looking at discretionary trust, which is created for tax plan. Now, when the beneficiary is getting the income, it's taxed on receipt basis. It's a non-saving income, and withholding tax is 45%. Let's apply this concept in a practice question. Let's look at it so that you can understand in a better manner. Okay, let's look at a practice question. Okay, so Mr. Z has following incomes for the year. Trading income is 17,000. Income received from discretionary trust is 9,000, on which the withholding tax is 45%. Okay, and then you have dividend income of 25,000. You have to do the tax payable. I believe it's not difficult. Just look at it. Income tax return. Okay. Now, one category is the non-saving income and the other is dividend. Okay. Look at it. I want you all to listen to me very carefully. Now, there is trading income 17,000. There is trading income 17,000 goes in the head of non-saving. Discretionary trust, it's 9,000, but 45% is the withholding. Now, whatever you have received is 55%. Think logically. Think logically. 45% was deducted at source. So, whatever you got was 55%. So, divided by 55 multiplied by 100. Okay. So 9,000 divided by 55 multiplied by 100. So it's 16,364. Okay. And then comes the dividend income, which is 25,000. It goes in the head of dividend. Done. So non-saving income, trading income, income received from discretionary trust divided by 55 multiplied by 100. And then comes the dividend income. You add up all of them to arrive at the value of total income.
Okay, 33,364, and here it is 25,000. Done. Now you deduct the personal allowance from it. Your personal allowance is 12570, and you arrive at the value of taxable income. Here you go. Okay, so your taxable income will be 33,364 minus 12570. It's 20794, and here it's 25,000. I hope you are getting it. Income tax return, trading income goes in non-saving. Discretionary trust is grossed up. 45% was the withholding, and then comes the dividend. Now you'll charge tax on it. Non-saving income 20794 till 37,700. It's basic rate band. So this 20794 will be taxed at 20%. It's 4159. Okay. Then there is dividend income, which is 25,000. First 500 pounds will be taxed at 0%. So that gives you 0. Now the basic rate band is still 37,700. So now what's the remaining space in the band? 37,700 minus 20794 minus 500. So it's 16406. Now the basic rate of tax for dividend income is 8.75%. 8.75%. So it's 1436. So here you go. The dividend income gets taxed. Now what's the remaining dividend income which will go at the higher rate band? See, it's just the routine steps which we have performed in the previous three questions also. 25,000 minus 500 minus 16406. So dividend income remaining is 8094 multiplied by 33.75%, because now you are at the higher rate band. So that gives us 2732. You add up all of them to arrive at the value of tax liability. I'll repeat the things again also, so don't worry about it. 4159 plus 1436 plus 2732. So 8327 is your tax liability. You will adjust your tax credit, the advanced tax from it. What was the tax credit which was paid on the discretionary trust? 45% withholding. 16364 minus 9,000. So the credit is 7364. And here you go. You get your tax payable. See, the only new thing was the grossing up adjustment for the discretionary trust. Rest was its concept only. Minus 8327. So it's 963 as the tax payable. Let me repeat it again. If you look at it carefully, in this question, you had trading income, which is just a normal non-saving income. Income received from discretionary trust on which there is 45% withholding. So if 45% was deducted at source, what you got was the 55% portion. So you gross it up, divide by 55 multiplied by 100. And then comes the normal dividend income. You add them to arrive at your total income. You adjust your allowance to get the taxable income. Now you charge the tax. In the basic rate band, it's 20%. First 500 of dividend goes at 0%. Look at the remaining space in the band. 8.75% is the basic rate of tax for dividend income, and the remaining dividend gets taxed at the higher rate band. So what is a trust? A separate body created in which the donor is giving the asset, managed by the trustees. Benefit is of the beneficiary. Are you getting it? Okay. Then we look at the fact
that in the trust, what are the reasons? Discretionary trust managed by the trustees, full power of the trustees. They use it for income tax planning. They adjust the number of beneficiaries. But now, whenever the beneficiary is getting the income, there is 45% withhold, which need to be grossed up, and then the tax will be charged. Is it clear? Let's look at one more practice question. As you do more and more practice, the things will get clear. Okay, let's look at it. Mr. J has following incomes for the year. Property income is 18,000. Income received from discretionary trust is 10,000. And dividend income is 20,000. We have to do the tax payable. Just routine steps. Income tax return. Okay. There are two heads of income currently, non-saving and dividend. There is no saving income in the question. Non-saving and the dividend income. There is no interest income given. So the property income is 18,000, which goes under the head of non-saving. Then you have discretionary trust. 45% is the withhold. So whatever you get is 55%. Whatever you get is 55%. So 18182. That goes in non-saving. And then you have the dividend income of 20,000. Here you go. Done. You add up them to arrive at the value of total income. Your total income will be 36,182 and 20,000. Done. You adjust your personal allowance 12570. You adjust your personal allowance to arrive at the value of taxable income. Here you go. This is your taxable income. Okay, 36,182 minus 12570. It's 23612, and here it's 20,000. Done. Let's charge tax on it. On the non-saving income, 23612, it's in the basic rate band, which is still 37,700. So the rate of tax will be 20%. So it's 4722. Then there is dividend income 20,000. First 500 will be taxed at 0%. That gives you 0. Now your basic rate band is 37,700. Done. What's the remaining space in the basic rate band? What's the remaining space in the basic rate band? Let's look at it. 37,700 minus 23612 minus 500. So it's 13588. The basic rate of income tax for dividend is 8.75%. I believe that this is not difficult. 37,700 is the basic rate band. 37,700 minus 23612 and minus 500, you get the remaining space in the band. So 8.75%, it is 1189. How much is the dividend remaining now? That will be taxed at higher rate band. 20,000 minus 13588 and minus 500. So it's 5912. Higher rate of tax for dividend is 33.75, which gives us 1995. Here you go. That's your tax liability. 4722 1189 1995 7906
You adjust the advance tax, which I believe was paid in relation to the discretionary trust. You grossed up 10,000 to 18182. So obviously you can identify the withholding, which was 8182. So this time you have a refund, and this refund will be given because it's an adjustment of advance tax. It's not a loss, it's an adjustment of advance tax. So you have a tax receivable of 276 that you can take from the tax authority. So if you look at this question, I believe that it's not difficult. Property income is non-saving. Discretionary interest 45% withhold. So you gross it up by 55 and multiply by 100. Dividend goes in the head of dividend. Then it's just applying the routine tax rate. Non-saving income in the basic rate band is still 37,700. It's 20%. In dividend, first 500 is always at 0%. Look at the remaining space in the band, 8.75, and the remaining goes at. So if I start to sum up my today's class, we started our discussion with the dividend income, that the profit distributions received from the company are taxed as dividend income. It's a separate head. We looked at the rates of tax for the dividend income. First 500 pounds are always taxed at 0%. We talked on that. And on dividend income, there is no withholding tax. We applied this in 3 practice questions for the dividend income. We'll introduce the concept of the trust, a separate body, donor giving the assets, managed by the trustee for the benefit of the beneficiaries. And then we look at why the trust is created. Okay, to give income to those who cannot manage it themselves, like your small children, to create a systematic manner of income distribution, to do some income tax planning, like changing the number of beneficiaries using their allowances. Within the family, you can do a lot of planning. To do inheritance tax planning, like when the assets are in the ownership of the trust, every time on the death, you are effectively saving your inheritance tax, because if it would have been on the ownership of an individual, on every death there is 40% IHT. Then discretionary trust, managed by the trustees, full powers of the trustees, created for tax planning purpose. The trustees change the number of beneficiaries to target their personal allowances and VAT. For the beneficiary, whenever you get it, it's non-saving income and withholding tax is 45%. We applied it in 2 practice questions. Now, in the next class, we'll do one more question on discretionary trust. And then we'll look at the second category in relation to the trust, which is interest in possession trust. And we'll do the practice questions in that regard. So by now, you must be able to understand my approach, that first I teach the concept. We do the practice questions so that you can have a clarity. And so on, we are building up the structure. We are trying and understanding the concept. And as the chapter progresses, then we'll be going for homeworks and assignments on which I'll be giving feedback. Okay? So hope to see you all in the next class. And if you have any query, feel free to contact me on my WhatsApp number. Thank you, everyone.